Hi everyone, my name is Elias Tawake, and today I will present you the case of Doma and Federal Commission of Taxation, which was settled in the full federal court in Sydney on the 29th of November 2002. This case relates to Module 9 of this unit, and it discusses the changing between accounting systems, and in this case from a cash-based system to an accruals-based system, also called an earnings-based system. I will start off by giving an outline of this presentation. Firstly, I'll skim through the facts to give you a basic overview of what the case is about. Secondly, we look at the issue in dispute, why the case was brought to the court initially, and next I'll go through the judgment made and the decision reached, plus the reasons behind this decision. I will also include the legal principles applicable in this case and whether they are still applicable today. Lastly, I will comment on the implications of this case on tax practitioners nowadays. Let us begin with the factual background of this case. In the years leading up to and including the year ending 30th June 1997, John Doma ran his own accounting business as a sole practitioner and trading as John Doma Associates. He returned his income on a cash basis. During the next financial year, Mr. Doma introduced two former employees of his sole trader business into the business to form a partnership structure by way of a sale agreement. The new partnership was called Doma, Granger, Platt, and all goodwill and assets of the old business were transferred to the new one. It had also been decided that clients of the old practice should be billed for work in progress as at 30th June 1997, as they were not sold under the sale agreement. The partnership calculated income on an accruals basis for the subsequent years, including the year ending 30th June 1998. However, Mr. Dom was still receiving payments from debtors of his old sole trader business for the year ending 30th June 1998 and 30th June 1999. The taxpayer did not include this in his assessable income and used the case of Federal Commission of Taxation and Henderson as a case of reference to why he did not include the payments. The Commissioner issued amended assessments to Mr. Doma after an audit. He was being assessed on the payments received from debtors of the old practice. Mr. Doma objected against the assessment, but was disallowed. He then appealed to the Federal Court against the Commissioner's decision to disallow his objection and used Henderson's case to argue his point. The taxpayer argued that Henderson's case was authority for the proposition that income received by the taxpayer in any 1 year cannot be apportioned so as to calculate assessable income on a cash basis in respect of some income and the accruals basis in respect of other income. The Commissioner argued that the principle applied in Henderson had no application to his case. The decision applied only to a continuing business involving a single source of professional income for the taxpayer. Mr. Doma then decided to appeal this decision to the Federal Court. Those are the basic facts to this case, and now we look at the issue. The primary issue in the Federal Court was whether the payments earned on a cash basis by Mr. Doma as a result of work performed as a sole practitioner in the years leading up to the year ending 30th June 1997 was accessible upon receipt in the year endings 30th June 1998 and 30th June 1999, in which the appellant operated in a partnership but was using accruals-based accounting system. Mr. Doma's appeal would be dismissed by the Federal Court and he would appeal again, this time to the full Federal Court. I will discuss both of his appeals and the judgments that were passed for both times. When Mr. Doma appealed to the Federal Court, the primary judge of the Federal Court ruled that Henderson's case involved a continuing business conducted by the same taxpayers. In the present case, the partnership was a new venture which derived income that had no relationship with work done in the previous accounting period. The fact that the taxpayer derived income from the partnership, which was calculated on an accruals basis, had no necessary or logical connection with the receipt of money owed by reason of his business activities in the previous period, which, standing alone, would be taxable as cash received. There was nothing unusual about one taxpayer receiving income from various sources, which may be taxed in different ways. Despite the appeal being dismissed by the judge, it was ruled that penalties imposed by the Commissioner can be remedied. From here, Mr. Doma further appealed to the full Federal Court, and the issue for the full Federal Court was just to determine the correctness of the decision made earlier on by a single judge of the Federal Court. Mr. Doma used the same argument by referring to Henderson's case. He further stated that the question was not one of continuity, but rather simply at what point does a taxpayer derive income. The answer to this would rely heavily on whether the cash or accruals basis was used. The full Federal Court dismissed his appeal and again held that Henderson's case did not apply to this case. To reach the decision to dismiss the taxpayer's appeal, the full Federal Court agreed with the primary judge of the Federal Court in the following areas. Firstly, they had agreed with the initial reasoning made by the primary judge of the Federal Court in that the new practice, operated as a partnership, immediately replaced the old one, which is run solely by the appellant. The new practice used the same premises, same employees, except for the two who were partners with Mr. Doma. And secondly, the full Federal Court also agreed that Henderson's case, which was strongly used by the appellant in his appeal did not apply to this case. With reference to the point made earlier, the two practices were entirely two different businesses. It is true that both businesses were accountancy businesses, that the latter business used the same premises and substantially the same employees as the first, but that is immaterial and if the business were, in law, different businesses. Those are the two main reasons which led the full federal court to dismiss Mr. Doma's appeal and order that he pay the respondent of his costs of appeal. Here are a few legal principles that are established by this case. Firstly, a taxpayer can derive assessable income from multiple sources. In this case, Mr. Doma derived income from his partner distributions and also receiving payments from his debtors from his old venture. He runs an accountancy business which he derives income from personal services and at the same time operating the business as a partner. There is no clear choice of which accounting method to use as evident to him changing accounting methods when he switched from sole trader to a partnership. Secondly, it was clearly a small business, and often, the larger the business, the more likely the accruals method is appropriate. It would be safe to assume that Mr. Doma should be employing the cash-based accounting system due to the size of his business. Thirdly, Mr. Doma's partnership business also did not rely on circulating capital to produce income and thus, the cash-based accounting system should be appropriate. And lastly, the venture was an accounting business that does not necessarily have formal procedures for extending credit and collecting debts. However, they did not usually provide credit, and as evident, debt recovery was generally not pursued. A cash-based accounting system would have been appropriate for them. It can be validated that Mr. Doma should have kept using the cash-based accounting system when changing from a sole trader to a partnership. To comment on whether the legal principles are still applicable today, they most certainly are. Lastly, I will now discuss the implications of this case on tax practitioners. There are gaps in the law when it comes to changes in accounting systems. There are no certain and correct ways contained in the Australian income tax law to resolve issues that arise with changes in accounting systems. So when the question first came before the High Court in Henderson's case, an important issue was whether judicial doctrines would overcome the gaps in law. Tax practitioners are then left to refer to the Tax Administration Act 1953 to correctly determine resolutions to cases such as this. Mr. Doma tried to argue against the Commissioner's amended assessment by referring to Henderson's case, but was unsuccessful in his objection and appeal. Furthermore, tax practitioners must correctly advise clients of the tax implications of changing accounting methods, whether within the same business or when also changing business structures. Mr. Doma was not aware of his tax obligations with regards to payments received from clients of his old venture. That's my presentation for today. Thank you for listening.